Thanks, Ross.
Well, I told you earlier about the boss of the banking regulator, APRA, Wayne Byers, today saying that the 10% cap on lending growth for investors is reaching the end of its useful life. We played you that grab a little bit earlier. Let's now just try and analyse this and what it does mean, because you can see in house prices coming down quite clearly if a lot of Chinese investors have gone, if a lot of local investors have been put off because of the higher interest rates they have been forced to pay. And this is a deliberate strategy of the banking regulator and also the Reserve Bank to try and take the sting out of housing markets around Australia. You could argue that it's working right now. The question is what happens next, I guess. Let's try and find out and work out exactly where the finance companies and the banks are going to do with all of this. Martin North from Digital Financial Analytics is watching this pretty closely. Martin, many thanks for your time. It is really interesting to see that they can turn off the tap. Now they've got to see whether they can turn the tap back on.
Yeah, it's quite interesting, isn't it? But remember, of course, that their intervention is not directly related to what house prices are doing, right? It's about what they call financial stability, in other words, the risks in the market. But you and I both know that they might argue that, but it's not really what happens in the real world, because if you suddenly put up the price of investor loans, or if you slow the amount of investor lending that's out there, quite clearly that's got to have an impact on the demand for housing, and if there's an impact on the demand for housing, the prices come off. Well, that's true, but then you've got to think about overall debt, right? So debt is even now still growing at 3 times income and 3 times inflation, right? And it's been doing that for quite some time. So there is still a debt problem in Australia. That hasn't gone away. And so my reading of the situation is that they have now put other measures in place, for example, tighter lending standards. In other words, you need a larger income. You have to be much more careful about declaring your costs. All of those things are in the system now. So what I think he's saying is that the raw measure of, the 10% cap really is over now, but there are other mechanisms in place to try and control the risks in the system. Now, that may well mean that we see some rise in investment lending, but I don't think it'll be a big rise. And I think that's because fundamentally, if I look at investors, they are really voting with their feet at the moment, and they're actually not really dancing at all. And I don't think that's going to change. And of course, as prices slide, the capital appreciation that we've had over the last 2 or 3 years is dissipating, and that's the other factor which we've got as the balance in all this conversation.
I'll tell you one interesting thing he said in this Senate hearing today. He talked about tax, which obviously is changes in tax laws which the Labor Party is proposing, changes to capital gains tax, changes to negative gearing, and also interest rates, because it would seem that what the banking regulators have done has taken some significant pressure off the Reserve Bank having to shift interest rates around. Just have a listen to this.
It is easier for us to target particular sorts of activity, I think, than to change tax rates. It's also probably easier for us to target particular sorts of activity than to have the Reserve Bank change interest rates, which apply to everybody across the board. So I think these measures, we can certainly be more nimble than some other measures that might be used, albeit other people have accused us of using blunt measures. So I think it's in the eye of the beholder.
So, Martin, it's kind of fascinating to think that maybe we've now got to start to watch the bank regulator APRA in its moves, subtle though they sometimes might be, as distinct from watching the Reserve Bank, which we have done so fastidiously for so many years.
Yes, I would say APRA has finally woken up to the risks in the system. And, they should have been doing this 5 years ago, because the debt issues we now have and the very high home prices we now have, we've got to try and manage through. But yes, you're right. They're starting to calibrate their approach to the market and target specific areas. Serviceability is really where they're focusing. They're also worried about interest-only loans and making sure that they don't go out of kilter. But, of course, they're tightening all of these going forward for new loans. The real question, though, is what about all those loans that have been written over the last 4 or 5 years when standards are very, very loose? Because that's where the real risk in the system currently lies. And if rates were to go up at all, that would be a significant issue. So if they can manage to keep rates low for longer because of what APRA is doing, then that's probably good, but we're not out of the woods yet.
I'll tell you what, Martin North, always great to have you in the program from Digital Financial Analytics, one of the really big watchers of the home lending market. And Mark, we appreciate your time.
Good to talk to you, Ross.